Hi everyone. We are now going to take a look at the two problems in part 1 of chapter 9 that we have for practice. I'm going to start with 930A, and this is where we are looking at estimating bad debt expense under the allowance method. Remember, the allowance method is the method we use for financial accounting. The beginning of your book talked about the direct method, and that's used for tax accounting. So we'll focus on the allowance method. And the major difference between the allowance method and the direct write-off method is the allowance method estimates bad debts in the year the sales occur, because bad debt expense is caused by sales on account. Any kind of expected bad debts should be recorded in the same year as the sale. So in your book, they've told us about two different methods of creating those estimates, usually done at the end of each year. They're definitely done whenever a balance sheet or an income statement is being created. So this is an adjusting journal entry, actually. Now, if you're sitting there saying, hey, we're estimating stuff. Yeah, we're estimating an expense. So this expense will decrease our net income. And that's why we do it even more, because if we just ignored that there could be a future bad debt related to this year's sales, we would report a little too much in sales from this year. We know based on past history that we will not collect all of our accounts receivables. We don't know who's not going to pay us, because if we knew that, we would have never sold to them on account to begin with. But we just know things happen. The world isn't perfect. So we estimate, based on past history, how much we probably won't collect. Now, one way of estimating is using the percentage of net sales, and that's what we're doing in problem 930A. So Delta Watches completed the following selected transactions during 2018. In part 1, they ask us to open T accounts for the allowance for bad debts and the bad debt expense account. And then they ask us to complete the journal entries for all these transactions. So let's take a look. It's December 31st of 2018. The company's been in business during the year, and they estimated that bad debt expense for this year's credit sales are 2% of the total credit sales of $450,000. So what they're saying here is they know, based on past experience, about 2% of their credit sales will probably become bad accounts going into the future. So let's take 2% of this year's credit sales and record them as bad debt expense this year. Increasing bad debt expense and storing the estimate in a contra account to accounts receivable called the allowance for bad debts. So we store the estimate in there until the account actually becomes bad, or an account does. Because remember, what happens at the end of the year to bad debt expense? It gets closed out. It gets reset to 0. So we've got to store that estimate somewhere. So that's what they're asking us to do in that second journal entry. So now bad debt expense is back to 0. We're going into 2019. We currently have a credit balance in our contra to accounts receivable. If it's a contra to accounts receivable, it increases on the credit side, and it will always increase when we record more estimate. So let's go to January 17th. Sold merchandise inventory to Max Smith, $400 on account. So here's a customer we sold to on account. We'll record that as we would any other sale, debit accounts receivable, credit sales revenue. June 29th, though, Max Smith, we haven't gotten his money yet, and we've decided to write his account off as uncollectible. Well, now we have an actual bad account. Remember, back in 2018, we estimated for the Max Smiths of the world. We didn't know who Max Smith was. It was going to be him, but here it is. So what do we do on June 29th? Well, we don't debit bad debt expense. We already recorded bad debt expense. Debit allowance for bad debts, where we stored the estimate, decrease that account and decrease accounts receivable. Just give me a timeout here. I'm trying to find my, here we go. Okay, so when we have an actual account become bad, we don't debit bad debt expense. We only debit bad debt expense when we're estimating. Actual bad debts get debited to the allowance for bad debts, credit accounts receivable, because that's actual. Now, on August 6th, we end up getting a letter from Mac Smith with $400. He apologizes for this being so late. We reinstate his account in full and record the cash receipts. So this is actually a two-step process. You may see it as one, and I do too, but we do two steps. The first is reverse the write-off. So when we wrote off his account as being a bad account, we debited allowance for bad debts, the contra account to accounts receivable, where we stored estimate, and we credited accounts receivable. Well, now we got to do the opposite. We got to reinstate his account so that it washes out the write-off. Debit accounts receivable for $400, credit allowance for bad debts. Put that $400 back in the estimate bucket. It's not bad. It's not a bad account. And then debit cash and credit accounts receivable, just like any other time we collect money from a customer. So you see the two-step process we have to go through. When an account we formally wrote off as being bad, we get the money for. Reinstate the account, reversing the effect of the write-off, and then bring the cash in and credit accounts receivable. The next journal entry, we have another actual bad accounts, a few of them. Cam Carter, $1,400, Mike Venture, $1,200, and Russell Reeves, $400. So just like before, we're going to debit the allowance for bad debt for the actual amount of bad accounts and credit accounts receivable for each one separately in this case. They're bad accounts. We're not going to get the money as far as we know. If we get it in the future, we'll do the same thing like we did for Mac Smith. Now, it's now December 31st again. Now we've got to estimate bad debts going into the future based on this year's credit sales. And we figure we're still keeping at 2%. 2% of our credit sales of $510,000 will become bad in the future. Debit bad debt expense, increase the allowance for bad debts for more estimate. You're filling up that bucket of estimate. That's what's on the credit side of allowance for bad debts. And then at the end of 2019, we know you'll reset bad debt expense to zero by crediting it and debiting income summary. So those are the journal entries we do when we're doing the allowance method, and we use sales to estimate for bad debts. Now let's take a look at the T accounts. Here we go. 2018, we credited the allowance account $9,000. So there's its balance at December 31st. Then we debited it on June 29th when we thought Mac Smith was a real bad debt. But then when we reinstated them, we credited that back into allowance for bad debts. Put that estimate back in there. But for the actual bad debts on December 31st, we debited it allowance for bad debts. And then, of course, the estimate at the end of 2019, we increased the allowance for even more estimate. So currently, the balance in the allowance for bad debts is $16,200. Bad debt expense is zero because we recorded bad debt expense, closed it out. Recorded bad debt expense, closed it out. Now in requirement 2, they say assume accounts receivables. The accounts receivables has a $136,000 balance. Well, before this chapter, we would just put $136,000 on the balance sheet. But now we have this contra account, accounts receivable. Just like accumulated depreciation decreased your equipment account on the balance sheet, allowance for bad debts decreases the amount we report of accounts receivable. So the balance in accounts receivable, that $136,000, is the amount we are legally entitled to collect. but we know some things are going to happen. And based on our best estimate, we feel we will not collect $16,200 of that. So that difference is the amount we actually do think we're going to collect, the $119,800. And that's how the allowance account is incorporated into our financial statements. So we've achieved our objective of recording bad debt expense in the year the sale occurs and reporting accounts receivable at a realistic balance, subtracting what we think we're not going to collect in the future. Okay, so that's the first way of estimating using sales. Now let's go up and take a look at the other method. And this method is, I got to take another time. Sorry about that. This method is the same thing. It's the allowance method. We estimate for future bad debts in the year that the sale occurs. But in this method of estimating, we use accounts receivables instead of sales to estimate. So we're given a choice. And this is the more accurate method and usually the one that is used because you're actually using the balance of accounts receivables to estimate for future bad accounts. So at September 30th, 2018, this is 929A on page 525, the accounts of Green Terrace Medical Center included the following. They give us the balance of accounts receivables starts at $145,000, and the allowance for bad debts currently has a credit balance in it of $3,500. During the last quarter of the year, they completed the following selected transactions. We need to open T accounts for accounts receivable and the allowance for bad debts and make the journal entries for these transactions. Well, you could see them right in front of us. The first transaction, sales on account $450,000. So we debit accounts receivable, credit sales revenue. Pretty straightforward, like we always have. So we just increased our T account, accounts receivable, that started with a balance of $145,450. The second transaction, the company collected on account for $27,100. So that's how much cash they collected. So debit cash, credit accounts receivable. So they collected a lot of it. The next transaction, they had some accounts though that became uncollectible. So just like before, because the allowance method is the allowance method, the only difference between what we're doing here and what we did in problem 930A is the way we come up with the dollar amount to estimate to put into our journal entry for bad debt expense. That's it. So we're still going to debit the allowance for bad debts and then credit accounts receivables for actual bad debts. Okay, so that's $2,900, and let's see, our allowance account started with a credit balance of $3,500. We just debited it for $2,900. Okay, so going into our estimating, the allowance account has a $600 debit or credit balance, $600 credit balance, and our accounts receivable, 595 minus, I'm just coming up with the balance in accounts receivables after those transactions, looks to be at $165,000. Now, at the bottom of page 525 is what we call an aging of accounts receivable reports. And this is a very common report we use in accounting, especially our collections people. And what it is there's, if we saw the entire report for this company, it would list all their customers, the amount each customer owed them, and then they would age the balance that the customer owes. For instance, if the customer owed anything from sales in the last 30 days on account, from December 31st, looking backwards, it's 1 to 30 days. It would be in that column. If we had sold to the customer as of December 31st, 31 to 60 days ago, it would be in the next column. So that means these amounts have been due for 31 to 60 days ago. The next column are 61 to 90-day-old sales. So the sales occurred 61 to 90 days before December 31st, they would appear in that column. And any sale on account that occurred over 90 days ago that we have not collected yet, and that's what this, remember, accounts receivable, we don't have the money yet, they would appear in that last column. As a balance in accounts receivables becomes older, past 31, even 61 days, it's more harder to collect. The chances of you getting that money become less and less likely. Now, what we do with this method is we take the total of that report. So we look just at the very bottom line and we go, what's the total amount of our accounts receivables that are 1 to 30 days old? Well, of the $165,000 debit balance in accounts receivable, $104,000 are 1 to 30 days old. 39,000 of them are 31 to 60 days old. $14,000 are 61 to 90 days. And of the $165,000 total that's due to us, 8,000 are over 90 days old. Then we say, based on past history, what percentage of each age group don't we expect to collect? And based on this company's experience, 0.3%, so not even 1%, are considered uncollectible. So be careful of that in your calculator. That's 0.003. 3% of 31 to 60 days old usually become uncollectible. 30% of the 61 to 90, and 35% of the over 90 days. Now remember, the company comes up with those percentages because it's based on their history, their actual experience. So you'll always be given that. So what do we do to calculate our estimate? We take our percentage we expect not to collect in each age group and multiply it by the total amount in each age group. So 104,000 times 0.3%, $312. So what we're saying there is, of the 104,000 that's 1 to 30 days old, we don't expect to collect $312 of it. We don't know who's not going to pay us. We're just coming up with an overall dollar amount in that category. We do the same thing with the 31 to 60 day old. We say, okay, 39,000 is what's the total amount in that column. 3% of that we don't expect to collect, or $13,000. I'm sorry, 3% or $1,170. I don't know where I got 13,000. The next column, 61 to 90, 14,000. 30% of those. So you see how that percentage gets higher, $4,200. And then of the 8,000, 35% are not expected to be collected, or $2,800. So we've estimated our total uncollectible for each age group. Now add those across. So you're going to add the 312 to the 1170 to the 4,200 to the 2,800. And your estimate is 8482. But that is not how much you put in your journal entry necessarily. How much do you put in your journal entry? Well, what you just determined is what the new balance after the journal entry is going to be in your allowance for bad debts. So what you need to know before you make your journal entry is, what is the current balance in the allowance for bad debts? So I'm highlighting it now. Remember, we start with a credit of $3,500. We debited for $2,900, those write-offs. So its current balance is a credit of $600. Well, we need the balance to go up to $8482. So we need to credit it an additional $7882. So once you post your journal entry, your balance in the allowance for bad debts should be what you estimated using your accounts receivable. So there's your journal entry. Debit bad debt expense, credit the allowance for bad debts, not for the amount you estimated, but the amount to get it from its current balance to your estimate of $8482. So you'll use $7882. And that's the crazy thing about this method. Sales, when you use sales to estimate, you just go, what percentage of sales don't I expect to collect? Plop that number in my journal entry. But when you use accounts receivables to estimate, you're determining the new balance in the allowance for bad debt account. And you make a journal entry to get it there, doing the opposite to bad debt expense. As you can see, and I told you to do this on your own too, but if you debit, you start your accounts receivable where it told us 145,000, increase it for the sales on account, decrease it for the collections on account and the write-offs. The balance is 165,000, which is also, and it should be, the balance on your aging of accounts receivable. So accounts receivable is 165,000. All we're doing is breaking it down by age. So it's a very specific estimate here. So on December 31st, 2018, when we record our accounts receivables on our balance sheet, we will have accounts receivable, a balance of 165,000, less the allowance for bad debts of 8,482, giving us net accounts receivables, or what we really think we're going to collect, 156,518. So everything's the same between the two problems, except for how we came up with our estimate and actually recorded it. Okay, so that's the way we handle accounts receivables in accounting. We estimate for bad debt, we get it recorded the same year as the sale. We'll either use sales to estimate or we'll use accounts receivable. We store that estimate in the allowance for bad debt on the credit side, and then when accounts actually become bad, we debit it and decrease that account. Now, if you're sitting there going, will it ever equal zero? Unless you're an expert estimator, probably not. Now, how do we fix that? We change the amount we estimate. Remember, your percentage is not locked in. In our problems, in that first problem, we used, what, 2%? Maybe you'll change it to 1%. Okay, so you're not locked in. You're always going to change that to reflect your history. So please keep that in mind. If you have any kind of questions, please post them to the discussion board.